Hello people, what's up? I hope you all are doing super amazing. People, this is CS Balgopal, Sridharan, and we are going to study corporate and economic laws for our CMA final exams. So people, which chapter were we studying? We were studying the chapter of SEBI regulations. We were studying the chapter of SEBI regulations, chapter number 4. And among SEBI regulations, we were studying the sub-chapter of how to raise finance from the capital market, that is IPO. So people, quickly we will go through whatever we have studied till now. So people, we understood first the meaning of IPO, number 1. Number 2, we understood who are the key players in an IPO. We understood who is NSE, BSE, NSDL, CDSL, issuer, DMAT, investors, every single thing we understood in our last lecture in complete detail. Number 3, people, we also understood offer for sale concept. That is, without issuing new shares, a company still can go for an IPO just by selling their existing shares to the shareholders. Okay. After that, one sec, people, one sec. Okay. Yes. We understood the meaning of IPO. We understood who are the key players in IPO. Very easy. Then we understood the eligibility of issuer, that is, which companies can first think of an IPO before they even think about can they go for an IPO or not. First, a company has to think about an IPO. Then only they have to think about the conditions for an IPO. Okay. So we are done with the eligibility of issuer also. Next, people, we understood intermediaries. Who are the intermediaries? We understood banks, registrar to the issue, syndicate member, underwriters, and compliance officer. All types of intermediaries we understood. Okay, people. Then appointment of intermediaries also we are done with. Now comes 1, 2, 3, 4, 5 topics. 5 topics. Among those 5 topics, people, promoters' contribution is little difficult, and conditions on IPO is little difficult. Remaining all the topics are, people, it's a piece of cake. It's a piece of cake. It's going to be completely easy. Okay. So what we are going to do is, in this lecture, we are going to completely focus on these 2 topics. We are going to completely focus on these 2 topics. Which are those 2 topics, people? Promoters' contribution we are going to cover. Then we are going to cover the conditions for a company to go for an IPO. First, the company has to think of an IPO. Once the company can think of an IPO by complying those 10 conditions, then only the company will start to analyze can it go for an IPO or not. This is the, people, this is the heart of this chapter. This is the heart of the chapter. Okay, people. So first thing first, what we are going to do is we are going to study the conditions for a company to go for an IPO. We're going to study the conditions for a company to go for an IPO. People, by the end of the lecture, I will tell you a small story. It's a completely practical story that happened in United States, because of which you might understand the importance, you might understand the seriousness of why SEBI is into the picture. Okay, people, we'll keep it for the last. Till now, right now, we are going to focus on conditions for an IPO. Then we'll cover promoters' contribution. Very simple, people. Okay. All right. All right. Hello. Okay. So people, when can a company go for an IPO? First, the company has to think of an IPO. Company has complied with the 10 conditions. Now the company is going for an IPO. When the company is going for an IPO, what all conditions it has to comply with? Let's understand this. This is the, people, this is the heart of the chapter. This is the heart of the chapter. Okay. So people, there are how many sets of conditions? A, B, and C. How many sets of conditions are there, people? A, B, and C. So A has got 3 conditions. A has got 3 conditions. B has got 1 condition and C has also got 1 condition. B and C is very easy. The main thing is, people, A conditions is little difficult. At the same time, it makes a lot of sense. It's going to be the heart of the chapter. Okay, people? Chalo. Now, people, what is the condition says? Net tangible assets requirement. Net tangible assets requirement. Now, what is the meaning of net tangible assets, people? Net tangible assets means those assets which we can see, those assets which we can touch. Now, tell me, people, can goodwill be called as a tangible asset? No. Can copyright be called as a tangible asset? No. Can patent, trademark be called as a tangible asset? No. But can plant, machinery, land, building, furniture, can these things be called as a tangible asset? Obviously, the answer is yes, because these are things that we can see. Okay. Now, people, what does the condition says about net tangible assets? Let's understand. Number 1, the issuer, Lenskart, must have net tangible assets of at least 3 crores in each of the preceding 3 financial year. So, first condition is very, very simple. Lenskart, if it is going for an IPO in 2025, Lenskart, if it is going for an IPO in 2025. Let's come over here. Yes. Lenskart, if it is going for an IPO, Lenskart. Now let's understand what does the rule say, people. Let's understand what does the rule says. The issuer means Lenskart, must have net tangible assets of at least 3 crores in each of the preceding means what, people? Previous 3 financial years. So in 2024, 2023, 2022, Lenskart must have net tangible assets worth at least 3 crores. At least 3 crores. At least 3 crores. Then only the first condition will be said to be complied. So first condition is very, very simple. Lenskart, if it wants to go for an IPO, it has to have net tangible assets of at least 3 crores in each of the 3 preceding financial year. In each of the 3 preceding financial year. Okay, very easy. Now, people, this point was very, very easy. Now, the second point is little interesting. What does the second point says? Not more than 50% of net tangible assets. Not more than, people, what? What is the meaning of not more than? Not more than means not exceeding, or we can say less than. Okay, these are the legal terms that you should be aware of, people. Not more than means what, people? Not exceeding. Not exceeding means what? Less than. So less than 50% of net tangible assets should be held in monetary form. It should be held in monetary form, means liquid form, cash in hand, cash at bank. Now, people, important question is, now let's, before we move on to the next sentence, first we'll understand what is the logic behind why this provision has been made. People, simple logic. If Lenskart has got 10 CR in its bank account, Lenskart has got 10 CR worth of net tangible assets. Let's assume for a second that Lenskart has got net tangible assets of worth 10 CR. Okay, in each of the 3 preceding financial year, net tangible assets is 10 CR. Net tangible assets is 10 CR. Now, the rule says that less than 5 CR should be held in monetary form. Which means what, people? more than 5 CR, you cannot have in monetary form. You cannot have in monetary form. Now, why is this rule made, people? The rule made is logic is simple, people. Simple. If Lenskart has got so much cash already with them, why are they raising finance from the investors? Number one. Number two is, if Lenskart has already got so much cash in their bank, that means what? Their money is kept idle, which means what? They don't know how to utilize this money wisely. If they don't know how to utilize their money wisely, what is a surety that they are going to use investors' money surely? Right, people? Investors' money wisely. Simple logic. If Lenskart has got more than 50% of net tangible assets in monetary form, that means what? It has got 50%, more than 50% of net tangible assets in cash form. This cash form is kept idle, which means what? Lenskart does not knows how to use this money wisely. Now, if Lenskart cannot use their money wisely, what is a surety that Lenskart is going to use investors' money wisely? That is the reason why this rule has been made, that not more than 50% should be held in monetary form. 50% of what, people? 50% of net tangible assets. Okay. Now let's come to the second sentence. If more than 50% is held in monetary form, that doesn't mean that you cannot go for an IPO. That means that you have to provide a firm commitment to utilize the excess in the business operations or project. Which means what? If at all you are holding more than 50% of net tangible assets in monetary form, that means you have to give a firm commitment to SEBI as to why has been so much money kept idle. Number one, how are you going to utilize the money of the investors? You have to give a firm commitment to SEBI, so that investors, SEBI, everyone will be rest assured that this company is going to use the money wisely. So rule says that Lenskart should have at least 3 crores net tangible assets in each of the 3 preceding financial year. Very simple rule. Number two, not more than 50% of net tangible assets should be held in monetary form. Logic is, money should not be kept idle. If the money is kept idle, you have to give a firm commitment to SEBI as to how are you going to utilize this money wisely. Very simple, people. Second rule. And now comes one of the most beautiful rules I've ever seen. This condition, whatever condition we have studied till now with respect to 50% criteria, this condition will not be applicable if the IPO is made entirely through offer for sale. Offer for sale. Now, people, let's come to the offer for sale concept. Where is offer for sale? Offer for sale. Yes. Yes. So, people, what is the meaning of offer for sale? A company going for an IPO, it has got 2 options. Either to issue new shares to the public, or you just sell the existing shares, or you just sell the existing shares. Now, when a company sells its existing shares to the public, it is called as offer for sale. Very simple, people. Now, people, the reason why this rule has been made is because now, yesterday's example you understood, Mukesh Ambani, Anant Ambani, Bill Gates. Now, people, you tell me, think logically, do you think Mukesh Ambani made any monetary profit with respect to this transaction? Think carefully, people, and answer me before the screen. Okay, Mukesh Ambani wanted the shares of Reliance to be listed on stock exchange. Okay, Mukesh Ambani does not want to issue new shares. Okay, Bill Gates wants to get an exit. Bill Gates wants to sell his shares. Now, Bill Gates sells his shares to the public. Public pays him money. Public gets the shares. Now, do you think Mukesh Ambani made any monetary profit? No. That is the reason why, people, this rule is not applicable. That is the reason why, people, this rule is not applicable, because Mukesh Ambani's pocket has not entered any money. There has no money entered into Mukesh Ambani's profit. Okay, there has not been any money entered in Mukesh Ambani's pocket. That is the reason why, people, this rule does not apply. So very simple. 3 rules we have studied till now. Number 1 is net tangible assets should be 3 crores at least in each of the 3 preceding financial year. Okay. Number 2, not more than 50% should be held in monetary form. If at all you are holding more than 50% in monetary form, you have to give a firm commitment to SEBI as to how are you going to utilize the proceeds. Number 2. Number 3 is the rule that we have studied about 50% criteria. This 50% criteria will not be applicable if the IPO is made through offer for sale, because Mukesh Ambani has not earned any profits. Very simple, people. This is the logic behind why these rules have been made. This is the logic behind why, people, these rules have been made. So first condition is net tangible assets requirement. Okay, we're going to again revise all the rules using mind maps. Don't worry, people. Okay, all right. Now second rule says minimum average pre-tax operating profit. Now what is the meaning of operating profit? We'll understand. Operating profit means that profit which has been earned using the core business, main business activity, not side business. Profit earned from main business activities is called as operating profit. Now what is the meaning of pre-tax operating profit? Operating profit in which tax has not been deducted is called as pre-tax operating profit, which means what? Profits earned from the core business activities where tax has not been deducted. This is the meaning of pre-tax average operating profit. Now let's understand what the rule says. The rule says the issuer must have a minimum average pre-tax operating profit of 15 crores. 15 crores, is it for 1 year? No. 15 crores during the 3 most profitable years out of the immediate preceding 5 years. Sir, I have not understood anything. Don't worry, people. That is why I'm here. Okay. So first step is you have to calculate. I have told you the meaning of pre-tax operating profit. Now first step is you have to calculate last 5 years pre-tax operating profit. Last 5 years, how much money the company has earned using its core business activities where tax has not been deducted. So let's take an example. In 2024, the company has earned 18 CR. In 2023, the company has earned 10 CR. In 2022, the company has earned 15 CR. In 2021, the company has earned 12 CR. In 2020, the company has earned 16 CR. Okay, no problem. Now, what we have to do is, once we have found out the last 5 financial years pre-tax or average pre-tax operating profit, now what we're going to do is, we are going to pick 3 of the most profitable years. Now, among these 5 years, which are the 3 of the most profitable years, people? Tell me, people. It is 18 CR, next is 16 CR, and next is 15 CR. So first step is we found out the pre-tax operating profit, not average, pre-tax operating profit of the last 5 financial years. Now among those last 5 financial years pre-tax operating profit, we need to pick 3 of the most profitable financial years. It is 2024, that is 18 CR, 2022, it is 15 CR, and 2020, it is 16 CR. Now, what you have to do is, you have to make an average. 18 plus 15 plus 16 upon 3. Quickly, guys, tell me the answer. Yes, the average pre-tax operating profit is 16.3 crores. 16.3 crores. Now, people, let's again go to the rule. Now, definitely, you will understand the rule. The issuer must have minimum, I will remove again this. The issuer must have a minimum average pre-tax operating profit of 15 crores minimum. Over there we got 16 crores, minimum 15 crores during the 3 of the most profitable years. But out of how many years? Out of the immediately preceding 5 years. Now did you understand, people? So first thing is we calculated the last 5 financial years pre-tax operating profit. Once we have calculated the 5 years pre-tax operating profit, what we did was we picked the 3 of the most profitable years. Once we picked the 3 of the most profitable years, we did an average of those 3 profitable pre-tax operating profit, and the average, if it is more than 15 CR, that means the company has complied with this condition. Very easy, people. Now there is one more thing. This pre-tax average operating profit is calculated on restated. Restated means what, people? There is no valuation error, there is no defects. It is called as restated basis. Restated and consolidated basis. What is the meaning of consolidated basis, people? Which means what? If Flipkart, which is a parent company, is going for an IPO, the subsidiary company's financial results will also be taken into consideration. That is called as consolidated basis. Again, I will tell you, people, the pre-tax average operating profit is based on restated means what, people? There is no valuation error, there is no defect. Consolidated basis means what, people? If the parent company is going for an IPO, the subsidiary company's financial results will also be taken into consideration. That's it, people. Very easy. So till now we have understood 2 rules. Okay, we're quickly going to revise all those rules once we are done with the B and C part. Okay, A has not been over yet, people. A is still there. Net worth. The issuer must have a net worth of at least how many crores? Of at least 1 CR. 1 CR, not in 1 year, in each of the preceding 3 financial year. In each of the 3 preceding financial year. Okay, let's come back to over here. So 2024, Lenskart should have 1 CR net worth. In 2023, Lenskart should have 2 crores, means more than 1 CR. And 2022, Lenskart is having 1.5 CR. Now, people, in each of the 3 preceding financial year, Lenskart has got at least 1 CR net worth. This means what, people? Lenskart has complied with the condition. Lenskart has complied with the net worth condition. Now, what is the meaning of net worth, people? Net worth means what, people? Once we pay off the liabilities, what amount of money will the shareholders receive? That is called as net worth. Once we pay off all the liabilities, what is the remaining money that will be held by the shareholders is called as net worth. Very simple, people. There is no rocket science in this. Okay. So now. So B condition says is okay. A condition, last rule says is that company should have at least 1 CR net worth in immediately 3 preceding financial year. Company should have at least 1 CR net worth in each of the 3 preceding financial year. Very simple, people. Okay. Now comes, we are done with the A condition. Now let's come to the B condition. What does the B condition says? Very, very interesting concept, people. Very, very interesting concept. If the issuer has changed its name within the last 12 months, if the issuer has changed its name in the last 12 months, at least 50% of revenue earned in the last 12 months must have been earned from the activity suggested by the new name. So, people, very simple logic, people. Very simple logic. If the company has changed its name, first I will tell you, company has earned 100 crores in the last 12 months. 100 crores in the last 12 months. Now, people, the company has changed its name in between. Company has changed its name in between. Let's say Box Televisions. Box Televisions Limited to AI Televisions Limited. The company has changed its name from Box Televisions Limited to AI Televisions Limited. Company has changed its name from Box Televisions Limited to AI Televisions Limited. In the last 12 months, company has changed its name. Now, what is the rule says is that if the company is going for an IPO with this new name, if the company is going for an IPO with this new name, the company should earn at least more than 50% of revenue earned in the last 12 months. Which means what, people? In the last 12 months, if the company has changed its name from Box Televisions Limited to AI Televisions Limited, and the company's last 12 months revenue is 100 crores, more than 50% of 100 crores should be earned using the new name, should have been earned using the new name, people. Again, I will tell you, company has earned 100 crores in the last 12 months. Last 12 months revenue is 100 crores, but during the tenure of last 12 months, company has changed its name. Company has changed its name. Now, what this rule says is that company has changed its name, no problem, still it can go for an IPO, but provided more than 50% of revenue should have been earned using the new name to go for an IPO using the new name. If the company has earned majority of its income using its old name, how can the investors trust the company? How can the investors trust the company once they hear of this new name, people? Do you think investors will trust this company? No. That is the reason why, people, this rule has been made. Again, I will tell you, the company has changed its name in the last 12 months. More than 50% of revenue earned in the last 12 months should have been earned using the new name if the company is going for an IPO. Very simple condition, people. Okay? All right. Okay. All right. So we are done with the people. A condition we are done with. Again, we'll revise. Don't worry. B condition also we are done with. Now comes C condition. C condition. Now, what this rule says is that if the company has not complied with A, the company has not complied with B, still the company can go for an IPO. Still the company can go for an IPO. How is this possible? Then why did we even study this A and B? People, the reason why we are studying A and B is because investors should not be harmed. Investors should not be frauded. Okay, people? Investors' money should be kept safe. That is the reason why, people, we are studying SEBI regulations. Okay? So, company, if it wants to go for an IPO, first it has to think about an IPO. Even to think about an IPO, it has to comply with the 10 conditions. Okay? Now, once the company has complied with those 10 conditions, what is the condition for a company to go for an IPO? Main conditions is A, next comes B. Okay? Now, C condition says that even if the company has not complied with A, if the company has not complied with B, still the company can go for an IPO provided at least 75% of net offer is given to qualified institutional buyers. Qualified institutional buyers. Now, what is the meaning of qualified institutional buyers, people? Qualified institutional buyers means what, people? Super big people like insurance companies, like banks, like portfolio financial institutions, like mutual funds. They are all called as qualified institutional buyers. Qualified institutional buyers. Now, people, you tell me. Now, if 75%, if the company is going for an IPO size is 100 crores. 100 crores is the IPO size. Now, 75%, that is 75 CR alone has been subscribed by the big players. They are called as banks, portfolio financial institutions, insurance companies, mutual fund, etc. Now people, logic is simple. If these big players who have got enormous amount of data, who have got enormous amount of talent to identify good companies from the bad companies, if they can easily distinguish between good companies and bad companies, if they can easily distinguish between what is a good investment and what is a wrong investment, if these people can invest 75% of the IPO size, don't you think these people have did some background work? Don't you think these people have did some research work? That is the reason why people they're investing into this company. Otherwise, do you think any random company they would invest in? No. If these big players are genuinely investing into this company, that is 75% of IPO size, that means the company is genuinely, it's some kind of gold. The company genuinely has got some potential to go for an IPO, and that is the reason why people, this exception has been made. But strictly 75% of the IPO size should be completely subscribed by the qualified institutional buyers. Otherwise, the company has to refund all the money back to the investors. Very simple, people, very simple. And refund the money, refund the subscription money if it fails to do so. Okay. So again, I will tell you people, book building process. What is the rule says is that company, even if it does not comply with A condition, even if it does not comply with the B condition, still it can go for an IPO, provided 75% of IPO size should be subscribed by the QIB. If they fail to even do that, they have to refund all the money back to the investors and they cannot go for an IPO. Very, 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 very simple, people. Okay. All right. Now. What we are going to do is, now we are going to revise whatever we have studied till now. So people, quickly. This is an unlisted company. This is an unlisted company. If this unlisted company, if it wants to go for an IPO, if this unlisted company, if it wants to get listed, what are the conditions? What are the roadways it has to go through? What are the ways it can go through? Okay. So number one is, people, very simple. Number one rule says is that company's net tangible assets should be at least 3 crores in each of the 3 preceding financial year. Company's net tangible assets should be minimum 3 CR in each of the 3 preceding financial year. Okay. Now, among those net tangible assets, not more than, that means what? Less than 50% of net tangible assets should be held in monetary form. Monetary form. Now, why is the rule made? Only to ensure that if company has got so much idle cash in their bank, why are they going for an IPO? Number one, how are they going to utilize this money wisely? What is the surety? If that is the case, the company has got more than 50% of net tangible assets in monetary form, it has to give a firm commitment to SEBI as to how are they going to utilize this proceed. Very simple. Number 2 rule says that minimum pre-tax average operating profit should be at least 15 CR in last 3 of the 5 preceding financial year. In last 3 of the 5 preceding financial year. Again, I will tell you, people, number 2 rule says is that company should have minimum pre-tax average operating profit of at least 15 CR in any of the 3 of 5 preceding financial year. Okay, and this pre-tax average operating profit should be based on restated and consolidated basis. What is the meaning of restated basis? Restated basis means what, people? There is no valuation error, there is no defect. And consolidation basis means what, people? If the holding company, if Flipkart is going for an IPO, Myntra, which is the subsidiary of Flipkart, their subsidiary financial results should also be given. Right, people? Number 3 is, people, net worth. Company should have at least 1 CR net worth in each of the 3 preceding financial year. Company should have at least 1 CR net worth in each of the 3 preceding financial year. 4th is my favorite. If the company has changed its name in the last 12 months, if the company has changed its name in the last 12 months, more than 50% of the revenue earned in the last 12 months should be earned using the new name. Should be earned using the new name. Okay, 4 conditions we have studied, people. Now, the next condition says that if the company, that is the alternate route alternate route. Even if the company does not comply with A, even if the company does not comply with B, no problem. What the C condition says? C condition says is that even the company does not comply with A and B, no problem. The company can still go for an IPO, provided 75% of the IPO size should be subscribed by the qualified institutional buyers. These are the big players. The company even fails to comply with that, it has to refund all the money back to the investors. The company is not fit for the IPO. This is the simple law. We have also understood the logic behind every single law, people. What else do you need, people? Okay, I'm 100% sure that by the end of this lecture, you will be thorough with all the rules and regulations that we have studied. Okay, people? All right. Okay. So people, now we are done with which topic? We are done with. Okay, we are done with the people conditions for IPO. We are done with the conditions for IPO. Okay, no problem. Now we're going to study the second most difficult topic, that is promoters contribution. It might sound difficult, people, but actually it is extremely easy. It is actually extremely easy. Let's understand. Once we are done with the promoters contribution, people, the remaining topics are cakewalk. It's going to be cakewalk for all of you. Okay, so people, in your exam, conditions for an IPO, definitely the question can be asked. Promoters contribution, question can be asked. Intermediaries, many times this question has been asked in the CMA final law exam. Okay, all right. Pricing of shares also questions has been asked. Okay, now people, what we're going to do now is we're going to study promoters contribution. Okay. Now, what is the meaning of promoters, people? Promoters are the ones who have started the company. Now, people, if the company is going for an IPO, if the company is raising thousands, 10,000 crores of money from the public, don't you think promoters' money should also be invested? Promoters' money should also be a part of the capital. The promoter himself has not contributed a single rupee to the company. How can the company even think of an IPO? How can a company even go for an IPO? Right, people? That means what? If the promoter is so much scared that he might lose his money, how can he play with the people's money? That is the reason why, people, this rule has been made. Promoters minimum, how much contribution it should there in the company before the company goes for an IPO. We're going to understand this. Very easy, people. Every single rule that we are going to understand, we're going to understand using logic. Okay, we're going to understand using logic. Okay, chalo. So what is the rule says? Minimum contribution. In an IPO, the promoters must contribute at least 20% of post-issue capital. 20% of post-issue capital. Let's say the company has already got capital of 100 crores. Company has got a capital of 100 crores. Okay. Now the company is going for an IPO. It is again going to raise 100 CR. Okay. Now what the rule says is that, what is the meaning of post-issue capital, people? Post-issue capital means when we add these two capital already there in the company plus the capital that we are intending to raise during an IPO, it is called as post-issue capital. Post-issue capital. That is how much, people? 200 CR. 200 CR is a post-issue capital. Now let's again come back to the rule. In an IPO, promoters must contribute at least 20% of the post-issue capital. Now what is the 20% of post-issue capital, people? It might come to 40 CR. Which means what? Promoter should have at least 40 CR invested in the company is going for an IPO of 100 CRs, which means what? If the post issue capital is people 200 CR, the promoter is supposed to put in how many CR people? 40 CR. 40 CR means 20% of post issue capital. 20% of post issue capital. Very, very easy, people. Okay. This is the basic rule. Now, people, we are going to understand one more rule. Now, this promoter's contribution, people now think for a second logically. Promoter, company is going for an IPO, company is going for an IPO, promoter and the promoter, Reliance is going for an IPO. I am Mukesh Ambani. Reliance is going to raise 100 CR in an IPO. It has already got 100 CR. Post issue capital is people how many CR? 200 CR. Okay. Now promoter Mukesh Ambani has to contribute how many CR? 40 CR it has to contribute. Mukesh Ambani has to contribute 40 CR. Now people, once I contribute 40 CR, can I immediately take it back? Would it make sense that once I have invested, immediately I will take it back? Would it make sense, people? No. That is the reason why, people, we are going to study the next law. Lock-in period. Lock-in period means what, people? Promoter cannot touch the money that he has invested in the capital contribution. So lock-in period is for two conditions. Okay, there are two conditions. Number one is the company is not deploying 50% or more of the IPO proceeds in a large capital project, which means what? The company is going for an IPO, people. It has got 100 CR is the IPO size. 100 CR is the IPO size. Now there are two conditions, two situations. One situation is more than 50%. That is, let's take an example like 60 CR. 60 CR is going to be invested into capital projects. Capital projects. This is scenario number one. This is scenario number one. Scenario one. Now, scenario two. Scenario two. Let's take less than 50%, that is 20 CR. 20 CR. Now we'll understand, people, what is the meaning of this, okay? Let's read this rule. If the company is not deploying 50% of more of the IPO proceeds in large capital projects, which means what? It has only invested 20 CR in its capital projects. This is scenario number two. So, company is going for an IPO, 100 CR is the IPO size. There are two scenarios. Scenario one says company is going to invest more than 50% of IPO size in the capital projects. Now, what is the meaning of capital projects? If Lenskart is going for an IPO, Lenskart will use that money to either open new stores. Open new stores, these are called as capital projects. Number two, it can invest into AI, or it can just use it to pay salaries. It can just use it to pay, buy laptops. It can only use it to pay uniforms for the staff owners. Okay. Capital projects means what? Non-capital projects means what? I've told you. Capital projects means what? The return that is going to take to come is going to take a lot of time. But in non-capital project, return is going to come immediately. Okay. So over here, capital projects will include artificial intelligence investment. Let's say open new stores. Open new stores. Or acquire a company. Lenskart is going for an IPO to get funds only to acquire company. Or copyright. We will take patent. We will take patent. Patent. Acquire a patent or acquiring an intellectual property. Intellectual property. Now, Lenskart is using such more than 50% of IPO size, more than 50% of IPO size in capital projects. Then, don't you think, people, don't you think there is some amount of risk involved? There is some amount of risk involved. Don't you think the company is investing into capital projects? The return is going to take a lot of time to come in. Don't you think there's a risk involved? if there is even a light bit of risk involved, people, okay, this is people case number 2. The case number 2, I have told you, the company is utilizing more than 50% in the capital projects. The lock-in period is for people 3 years. Lock-in period is 3 years. Okay. If the company is not using more than 50% as capital projects, then lock-in period is just 18 months. Lock-in period is just people 18 months. Why, people? This is short term, less risk, but this is people long term and more risk. More logic is simple, people. If the promoter is using the money towards risky project, their money should also be locked for 3 years. If the promoter is not using that much amount of money in risky projects, then he is not required to lock in for such a long period of time. Okay. Over here, where there is less risk, it is only 18 months. Where there is more risk, there is 3 years. Okay, people. Let's read this rule again, people. If the company is not deploying, that means less risk, 50% or more of the IPO proceeds in a large capital projects, the 20% promoter's contribution is locked in for a period of 18 months. That is 1.5 years. Okay. If the company is deploying more than 50% of the IPO proceeds in large capital projects, then the lock-in period is, people, 3 years. The logic is simple. Where there is more risk, more lock-in period will be involved. Where there is less risk, less lock-in period will be involved. Very, very extremely easy, people. Okay. Now, people, we are going to understand this 3 years, 18 months we are talking so many times. This 3 years will begin from which date? This lock-in period will begin from which date? This 18 months will begin from which date? We'll understand. Number one is, people, number one is commencement of the commercial production. Commercial production means what? I am raising finance. For what purpose am I raising finance? I want to build some AI technology. I want to open some new stores. The moment I start working towards it, it is called as commercial production. Or the date of allotment of shares to the public, whichever is later. Whichever is later. Okay. So, company has gone for an IPO. Company has raised 100 crores. Now, the locking period is 18 months. Now, this 18 months will begin from either of the later of the 2 dates. This locking period will begin from the later of the 2 dates. Number one date is what, people? Commencement of the commercial production, number one, or the allotment of shares in the public issue, whichever is later. If this one is later, then 18 months will begin from this date. If 3 years is later, then this, if commercial production is later, then 3 years or 18 months will begin from this date, people. That's it, people. This is the meaning of promoter's contribution. Okay. Promoter's contribution rule is simple. The company promoter has to contribute 20% of post paid up capital. Promoter has to contribute 20% of post paid up capital. Okay. Now, this 20% will be locked in for how long? There are 2 scenarios. Situation number 1, situation number 2. Situation number 1 says is that if the company is going to use more than 50% of IPO size in capital projects, in large capital projects where there is risk involved, then lock-in period is 3 years. If the company is not going to utilize 50% of the IPO size in capital projects, that means what? Less risk is involved, and over there the criteria is 18 months lock-in period. 18 months lock-in period. Very, very simple, people. Okay. Now this lock-in period will begin from later of the 2 dates. Later of the 2 dates. Number one is either commencement means what? Beginning of the commercial production, or the date of allotment of shares in the public, whichever is later. Whichever is later. Very simple, people. I hope you are understanding every single concept using the logic. Why are we studying these laws? If you have got any doubts, people, if you have got any doubts, please make sure and feel free to drop all your doubts in the YouTube comment section, people. I will be happy to resolve all your doubts as soon as possible. Okay? Okay. Now, people, now Now there's another situation. Another situation is that, people, let's say promoter has to contribute 40 CR. So post issue capital is 200 CR. Promoter has to contribute 20% of the post issue capital, 40 CR. Till here we are together. Now comes, supposing if the promoter has contributed 50 CR instead of 40 CR. In case the promoter is so generous that he has contributed more than the required contribution only to gain trust of the investors. Now again, people, again, rule comes. Any excess promoter's contribution above 20% will be locked in for 6 months. Earlier the lock-in period was, people, earlier it was 1 year. Now SEBI has told that if the promoter is so generous, we will not let him to have his money locked in for a period of 1 year. That is too much. Okay, the criteria that we want, 20% has been fulfilled. Now in case the promoter has contributed excess money of the minimum promoter's contribution, his money will not be locked in for 1 year. Instead, it will be locked in for only and only 6 months. Only and only 6 months. Okay, people, this is the reason why, people, this rule has been made. This rule has been made. Very simple, people. So till now we have understood 2 rules. Again we are going to understand 3rd rule. Then we are going to revise all the rules that we have studied till now. Okay. Now what is the meaning of IPO, people? IPO means offering shares to the public for the first time on stock exchange. IPO means what, people? Offering shares to the public for the first time on stock exchange. IPO means offering shares to the public for the first time on stock exchange. Now company has gone for an IPO. Company has raised huge amount of money. Company has used that money. Company has grown exponentially. Now, people, company again wants to grow 10 times more. Company has to grow 20 times more. In that case, company, when it again issues or offers shares to the public after the IPO, it is called as FPO. FPO means what, people? Once IPO is done, the company again wants to raise money from the public. It is called as FPO. FPO means what, people? FPO means further public offer. FPO means what, people? Further public offer. Very easy. Now the company has gone for an IPO. Promoters were subject to lock-in period. Now if the company now again it is raising finance from the capital markets, it is going for an FPO. In that case, people, in that case, this lock-in period will not be applicable. In that case, lock-in period will not be applicable. Lock-in period will not be applicable. In case of further public offer, shares contributed by promoters are not subject to any lock-in, So people, we've understood 4 conditions. Okay. Now let's understand using the mind map now. Mind map. Where is the mind map? Where is the mind map? Yes. So people, rule says very simple. Minimum promoter's contribution is 20%. Now 20% of what? 20% of post-issue paid up capital. Post-issue capital. Now we all know this. Company is going for an IPO of 100 CR. Company has already got capital of 100 CR. Total capital is 200 CR. Now this 200 CR's 20% is 40 CR. Promoter has to contribute. Promoter has to keep his money invested in the company. He cannot withdraw this. Now lock-in period for till how long he cannot withdraw it? If, okay, people over here, just write it down over here. If more than 50% is used in capital projects, less than 50% is used in capital project. Over here, if more than 50% is used in capital projects, the lock-in period is 3 years. Otherwise, it is just 18 months. 18 months. Okay, people? Again, let's read this. Lock-in period. If the company is intending to use more than 50% of the money it has raised through IPO in large capital projects, in that case, the lock-in period is 3 years. If less than 50%, it is 18 months. Okay. Now, the 3 years, 18 months period will be starting from which date? Either on the date of commencement of production or on the date of allotment of shares in the public, whichever is later. Whichever is later. Very simple, people. In case the promoter has contributed excess money, apart from promoter's contribution, his money will be locked in for a period of 6 months. And this rule is not applicable for further public offer. That's it, people. That's it. Now, people, I can say that we are done with all the important, difficult provisions, important topics. Okay. Now we're going to understand whatever topics we're going to understand is completely a cakewalk topics. It's going to be completely cakewalk topics. The reason why, people, I always start with difficult topics is because so that now your brain is prepared. Your brain is prepared for the most difficult thing. Once you have acquired the most difficult thing in your life, now rest is very, very easy. Rest is going to be very, very easy cakewalk for you. Okay. Chalo. So we are done with which topics. Let's quickly understand this. We are done with the promoter's contribution. We are done with the promoter's contribution. Now, people, we are also done with the conditions for an IPO. Okay. Now, the remaining topics. Okay. Now, people, there are one more set of conditions for a company to go for an IPO. There are one more set of conditions for a company to go for an IPO. These are very, very basic conditions. Okay. First of all, the company has to think about an IPO. 10 conditions. Now, when the company is going for an IPO, it has to comply with the main conditions. Main conditions A, B, and C. Okay. Now that the company has also complied with the main conditions, when the company is in the process of an IPO, or the company has done with the IPO, these are the conditions the company has to comply with. How many conditions there are, people? 1, 2, 3, 4, 5. 5 very, very basic conditions. 5 very, very basic conditions. Okay. Number 1. IPO of convertible debt instruments. Now, people, what is the meaning of convertible debt instruments? Convertible debt instruments means what, people? Loans, debentures, bonds that can be later converted into equity shares. Let's understand this using an example. Let's say HDFC Bank has given 10,000 rupees worth of bonds to Lenskart on a condition that Lenskart will repay within 1 year. HDFC Bank has given a loan to Lenskart. What is the amount of loan? 10,000 rupees on a condition that Lenskart will repay within 1 year. Now, people, it has been 1 year. Now, HDFC Bank is asking Lenskart, buddy, where is my money? Bro, where is my money? Lenskart says, bro, we are still in the growing stage. Definitely 1 year, just give us time. We're going to grow exponentially. This is my promise. Lenskart says, this is my promise that we are going to grow exponentially. Huge. Now, HDFC Bank says, nobody, we do not trust you. Lenskart says, no problem. If you don't trust us, I will give you an option. these 10,000 rupees worth of bonds, these 10,000 rupees worth of bonds, Lenskart can later convert into equity shares, can later convert into equity shares, convert into equity shares. HDFC Bank can convert into equity shares. Now, Lenskart says that we are 100% sure that right now, at present, we are trading at 50 rupees. We are trading with 50 rupees. We know the share price right now is 50 rupees. How much, people? 50 rupees. We know that in the future, after 1 year, our share price is going to be worth 100 rupees. Our share price is going to be worth, okay, we will take 200 rupees. Our share price is going to be worth 200 rupees. Lenskart says that, Lenskart says to HDFC, buddy, right now our share price is rupees 50 rupees, but we are 100% sure that 1 year down the line, our share price is going to reach 200 rupees. Our share price is going to reach 200 rupees. But when the share price is going to reach 200 rupees, we will give you an opportunity, to convert this loan into equity shares worth of rupees 100. Equity shares worth of 100. Okay. So over here, people, HDFC Bank will be benefited during this transaction. HDFC Bank will be benefited with this transaction. I'm only explaining the concept of convertible debt instruments. I'm only giving you an explanation of convertible debt instruments. HDFC Bank can convert this 10,000 rupees loan into equity shares of 100 rupees each. Now 10,000 upon 100. Lenskart will get 100 shares at rupees 100, whereas the market value of the shares is, people, 200. Don't you think Lenskart is being benefited with this transaction, people? That is the importance of convertible debt instruments. Convertible debt instruments. First, Lenskart took a loan of 10,000 rupees from HDFC Bank. HDFC Bank said that, buddy, you have to repay within 1 year. Lenskart says, buddy, obviously I will pay within 1 year. But after 1 year, Lenskart says that, bro, I don't have money right now, but definitely 1 year, give us time, we are going to grow exponentially huge. Then HDFC Bank says, if you are so confident about your company, give us the shares, give us the opportunity to convert this loan into equity shares if you are damn sure about this exponential growth. So Lenskart says, okay, you can convert this 10,000 rupees loan with equity shares, which is going to be value of 100 rupees, whereas we know for sure that 1 year down the line, after 1 year, the price is going to reach 200 rupees. You will be benefited with this transaction. This is called as convertible debt instruments. This is called as convertible debt instruments. Okay. Now let's understand this. What this rule is that, people, company can issue convertible debt instruments through IPO without having issued equity shares earlier. Which means what? Normally company issues equity shares. Now this rule says is that company without even issuing equity shares for the first time, it can still go for an IPO, but provided they are not issuing debt instruments. They are not issuing debt instruments. They are issuing convertible debt instruments. They are issuing convertible debt instruments. That means it is allowed. The company is issuing convertible debt instruments for the first time on stock exchange, it will also be considered as an IPO. This is what the rule says. But there is a rule. There is a rule that says that provided that it has not defaulted in principal or interest in the last 6 months. That means what? The company has defaulted in the payment of principal or interest with any bank, it cannot issue convertible debt instruments during an IPO. Rule is simple. Rule says that you can issue convertible debt instruments without first issuing equity shares. Absolutely okay. I'm not saying debt instruments, people. I'm not saying debt instruments. I'm saying convertible debt instruments. Okay. In the end, people, what is the meaning of IPO? IPO means offering shares to the public for the first time on stock exchange. Now, people, convertible debt instruments means what, people? These debt instruments can be later converted into equity shares. Okay, that is the reason why this rule has been made. But this rule is only applicable if the company has not defaulted in repayment of principal or interest in the last 6 months. Okay, remaining rules are easy peasy. Next rule says the IPO must have at least how many allottees? 1000 allottees. Nothing rocket science. Minimum, if the company is going for an IPO, it should have at least 1000 allottees. It should have at least 1000 allottees. Now, next rule says is that no outstanding convertible securities. No outstanding convertible securities. What is the meaning of this? Let's understand. So, people, right now I have told you company can issue convertible debt instruments, but provided this rule, what we are going to study next, is complied with. Company has already convertible debt instruments. Company has already got convertible debt instruments which have the option to convert into equity shares. Okay, company has, the investors have not yet converted their debt instruments into equity shares. Company investors have not yet converted their instruments into equity shares. No, it is still in the form of instrument. Okay, no shares have been given to investors till now. Now, the moment company goes for an IPO, it has issued 100 new shares. It has issued 100 new shares, and the price, let's say there is no change in the price of shares. The price is fixed at rupees 100. The price is fixed at rupees 100. Okay, company has gone for an IPO in between, where the company has issued 100 new shares, and once the IPO is done, the share price has been fixed to 100 rupees. The share price has been fixed to 100 rupees. Now what happens is these people who are holding convertible instruments, they have not yet converted into equity shares. No, these people are still holding convertible instruments. Now, after 6 months or 1 year of the IPO, these people convert instruments into equity shares. Now, these people convert the shares into equity shares. Now, people, you think logically. Earlier there were how many shares? 100 new shares were there in the company till the time they have converted their equity shares. Okay, company had 100 new shares. Now, because these people converted into equity shares, suddenly company has got 100 plus. Company has got 100 plus 100 shares. Company has got 100 plus 100 shares. Now, don't you think, people, don't you think suddenly if supply of shares increases, the price of the share will also decrease? Suddenly, if there is huge supply of shares, don't you think the price of the share will reduce? Don't you think the price of the share will reduce, people? And if the price of the share reduces, don't you think the ones who have subscribed in an IPO, they might face tremendous amount of losses? Only because these people have converted their instruments into equity shares. Don't you think? That is the reason why, people, the rule that we are going to study next has been made. An issuer must not have any outstanding convertible securities or any rights that would entitle the holders to receive equity shares after the IPO. Very, very simple logic, people. The company has already got convertible securities. First you convert them into equity shares. Then you go for an IPO, it is fine. It is fine. If you do not convert them into equity shares, and if you're going for an IPO after 6 months, these people will convert their shares into equity, convert their instruments into equity shares. Suddenly there will be huge supply of equity shares in the market, and because of which price of share will fall down, and because of this again investors who have subscribed their shares in an IPO, they will suffer tremendous amount of losses. That is the reason why people this rule has been made. Very, very simple. Okay. Now next, monitoring of proceeds. Now which means what, people? If the IPO size exceeds 100 crores, a bank or a private financial institution must be appointed to ensure that HDFC Bank or any private financial institution is monitoring how the company is utilizing their proceeds, and they have to report to SEBI until 95 proceeds have been utilized. Sir, I did not understand anything. No problem. Number 1, IPO size exceeds 100 crores. IPO size exceeds 100 crores. IPO size reaches, let's say, 200 CR. Okay. Now, once the IPO size has reached 200 CR, now the company Lenskart has to appoint a bank or a private financial institution. For which purpose? So that they can monitor how this 200 CR will be utilized, plus they need to report to SEBI. On a quarterly basis. Every 3 months they have to report to SEBI with respect to the company has used this much amount of money in XYZ things. Company has incurred XYZ expenditure with using these IPO proceeds. Until when are they going to report to SEBI? Until 95% of proceeds have been utilized. Until 95% of IPO proceeds have been utilized. Which means what? HDFC Bank has to report to SEBI until 190 CR have been utilized out of 200 CR. They have to report on a quarterly basis, people. Very, very simple rule, people. Because to ensure the people, the company is raising huge amount of money. If the company is raising huge amount of money, they must be monitored so that that money is being used in a right manner. The money is being used in a very, very wise manner, cautious manner. The company is not spending that money lavishly. Okay. The last law that we're going to study is, after that we will hear a small story. The issuer may voluntarily obtain IPO grading. Now what is the meaning of IPO grading, people? Now let's say I will pick the name of a company, Oreva. Okay, I will pick the name of the company of this plug point, that is Oreva. Okay. Now have you ever heard of the company called as Oreva, people? No. Now if a company like Oreva is going for an IPO, the company like Oreva is going for an IPO, this company you have never even heard of. How will you even invest in that company? Because you have never heard about that company, right? If I say LIC is going for an IPO, you will suddenly invest. If I say Lenskart is going for an IPO, you will invest. If I say Ola is going for an IPO, you will invest. Now, if company which is completely unknown company, it's a genuinely different company. Nobody has even heard about that company. If that company is going for an IPO, people, what is a surety that 90% of subscription will be subscribed by the public, 90% of IPO size will be subscribed by the public? Obviously, nobody have even heard about that company. If it's genuinely a potential company, if it's genuinely a good company, don't you think it doesn't make any sense for investors not investing into the company? Yes. So that is the reason why, people, if the company is a new company, if the company wants to gain trust from the investors, the company basically wants to gain trust of the investors, they will appoint a SEBI registered credit rating agencies. These are the agencies that take care of the entire financial reporting of every single company, individual and all. They have got every single financial data of everyone. Okay. So CRA are the ones who have got all the data, financial data of every single person. Okay. Now, this Oreva company can obtain a report, can obtain an IPO report. Okay. This IPO report will contain details like how much money are they going to raise during an IPO, where are they going to utilize that money, is the demand for where they're going to utilize that money is going, or is that money going in a total waste of resources? Basically, is the company going to utilize this money wisely? Basically, are the investors going to earn any normal returns, earn any handsome returns only because they're going to invest in an IPO? To obtain this report, this Oreva company can get a IPO grading from one or more SEBI registered CRA. SEBI registered CRA. Okay. Basically, if a company, if it wants to gain trust from the investors, it can get its IPO graded from SEBI registered CRA, SEBI registered credit rating agencies. People, just one second, I'll just check every single thing is working. Yes, people, sometimes I'm very afraid that suddenly my microphone goes off. That's it. Okay, so my microphone is on. All right, people. So 5 additional small conditions we have studied. Let's now revise using the mind map. Number 1, people, company can issue convertible debt instruments for the first time on an IPO, but provided the company should not have defaulted in principal or interest in the last 6 months. Okay. Number 2, minimum number of allottees should be 1000. Minimum number of allottees should be 1000. Next is, people, company should not have any outstanding convertible securities. Either the convertible securities should be converted or it should be cancelled. Okay. If there is any outstanding convertible securities, immediately the company has to convert. After conversion, only the company can go for an IPO. After conversion, only the company can go for an IPO. Okay. Next is, once the IPO size exceeds 100 CR, once the IPO size exceeds 100 CR, the company has to appoint a bank or a private financial institution to monitor how they are going to utilize this money. Now, this reporting, bank has to report to SEBI on a quarterly basis until 95% of proceeds have been utilized. Until 95% of proceeds have been utilized. Very simple. And next is, the company wants to gain the trust of the investors. The company can appoint CRA to get their IPO graded. It's like a report card of an IPO, so that investors can know कि yes, CRA have given a grade of A, CRA has given a grade of E, which E means very bad, D means, you know, A, B, C, D, like we have in schools. A means very good, B means okay, and C, D, and so on. Okay, if the CRA have rated as A, that means the company is top notch, it is worth investing into that company. Okay, people. So these are the 5 conditions. All right, people. Now, people, I hope you are having super huge fun in the lectures. We are understanding law also using the logic. Okay, so we are done with, okay, over here. Now two topics are remaining, people. Two topics are remaining. So what we are going to do now is, people, we're going to cover these two topics in the next lecture, but along with those two topics, it is a very simple topic. It will be done in 15 minutes. Remaining time, we're going to revise all the concepts and we're going to solve the question answers. Okay, we're going to solve the question answers. Cool, people. Now before we end, those who are super exhausted, it's okay, but I want to tell you a small story as to why are we studying SEBI regulations. I want to tell you a small story as to why are we studying SEBI regulations. People, we all have heard this company called as, Ford. Okay, Ford is one of the biggest companies in the world. Its market value is $25 billion. $25 billion. Now this $25 billion is equal to, people, like 2 lakh crores. 2 lakh crores. If every single person in Mumbai has got 1 lakh, every single person has got 1 lakh in Mumbai, the entire population size, entire population's bank account combined would be the market cap of Ford. Market cap of Ford. Now this is the year I'm talking about, in 2020. 2020. Now people, we all have heard about this company. This company is into existence since more than 100 years. More than 100 years this company is into existence. Ford. Okay. If a company being into existence since more than 100 years, it's an amazing company. Only then its market value was so huge that it reached $25 billion. Can you even imagine how big is that? But there was one more company. Which surprisingly equal to Ford Motors market cap in just 6 years. How is that possible? Okay, there was one more company that also earned a market cap of $25 billion in 2020, but this company was into existence since just 2014, which means what? In just 6 years, the company has reached a market value of that company, which is a really amazing company, and that company was into existence since 100 years. How is that even possible? And that company's name is called as, people, Nikola. That company's name is called as Nikola. Okay, I will tell you what did Nikola do to achieve such tremendously huge market capitalization. Okay, number one, Nikola is into the business of manufacturing trucks. Nikola is into the business of manufacturing trucks. Number one. Number two, Nikola made huge plans. Number one, they announced that the trucks that we are going to make is going to be run on compressed natural gas. The truck is going to be run on compressed natural gas, and it is going to give a mileage of 1000 miles, more than any other truck company, more than any truck company. So number two, this Nikola announced that we are going to make trucks that is going to be run on compressed natural gas, and the mileage is going to be 1000 miles more than any truck company. People went crazy. How is it possible? Something great is going to come in. Something revolutionary is going to come in. Number three, after some time, they made a more grand plan. They said that we are going to make trucks. We are going to make trucks that is going to be run on hydrogen. That is going to be run on hydrogen. It's a sustainable fuel, people. Sustainable fuel is the now future now. Now Nikola announced that we are going to make trucks that is going to run on hydrogen. Again, people went crazy. Some people told that if you are going to manufacture trucks that is going to be run on hydrogen, the cost of your truck is going to shoot up like anything. And then Nikola again told that the trucks that we are going to make, the hydrogen that we are going to manufacture is going to be completely in-house. Is going to be completely in-house. Which means what? The cost is going to be 80% less than our competitors. 80% less than our competitors. Okay. Again, people went crazy. How is it possible? What is this company doing actually? Everyone went bizarre. Then company did two more things. Company did two more things. Fourth thing company did was, company said that company launched a photo. Company launched a photo. 1 second, people, I'm writing phone. Company launched a press release where they very beautifully they showed the picture of the truck. Picture of the truck. Again, social media hype, investors, media, everyone was talking about that company, Nikola. This Nikola company is doing something crazy. Everyone was only talking about that company. The moment it launched the picture of the truck, that's it. And then people, and then last thing what they did was, they launched a short film, short video. They launched a short video where they were showing that the truck is moving. Where they were showing that the truck is moving. Truck is moving. By doing these four things, people, everyone were only talking about media, investors, companies, competitors. Everyone were only talking about Nikola. This company is going to be huge. This company is going to be huge. Now because of this hype created, Nikola decided that we have to now get ourselves listed. We have to get ourselves listed. So it decided to get itself listed on stock exchange. It decided to get itself listed on stock exchange. The moment it got listed on stock exchange, people, it got 800 new trucks order. It got 800 new trucks order. Once the company got listed on stock exchange because of this hype, it got order of 800 new trucks. Now people, because of the hype created, everyone wanted the shares of Nikola. Everyone was fighting that we want this shares, we want that shares. So because of this hype, people, this share price drastically, exponentially increased, and they matched to one of the greatest companies in the world, which was into existence since 100 long years, Ford Motors. And then they reached a market cap of $25 billion. $25 billion. That's it, people. That's it. And then people, do you know what happened? Number 6, companies like Bosch. Companies like Bosch invested into this company. Company like General Electric invested in this company. They bought 10% of the company's capital. They bought 10% of the shares of the company. So huge, so huge. And then people, and then listen to me very carefully. And then people, Hindenburg launched a report. And then Hindenburg launched a report where they said that we have actually investigated, we have actually inquired about the factory, every single place where the company operates, every single premises where the company operates, we have carefully investigated, and there was not even a single truck that we could see, there has not even been a single truck that the company had manufactured till now. And people, they were actually right. Hindenburg report was actually right. And then people, that's it. Share price kept falling, falling, falling. The company was penalized, the company was prosecuted, the company's founders were jailed. And that is how people, the company's share price just crashed. The company's share price just crashed. Now people, this is the reason why people, we are studying SEBI regulation, so that to prevent such fake companies to get so hyped up that they can get itself listed, and beyond getting itself listed, they just simply reach the market cap of one of the greatest companies in the US, which has been into existence since 100 long years. To prevent such things from happening, to protect the money of the investors, this is the reason why people, we are studying SEBI regulations. We are studying SEBI regulations. Okay, people. So that's it, people. That's it. We will end our session over here. Tomorrow we are going to complete with this chapter. Okay, people. So thank you so much for watching, people. It was so nice to teach you all. And if you have got any doubts, please make sure to drop all your doubts in the YouTube comment section. I will be happy to just resolve all your doubts in the most beautiful way possible. So thank you so much for watching, people. Bye bye. Take care. Eat well, sleep well, and study well. Okay. Bye bye, people.